The financial markets are currently closed, and as we look at the board on this Saturday, June 20, 2026, Navitas Semiconductor finished its last active trading session on Thursday, June 18, 2026, at an exact closing price of $24.02 per share, marking a strong intraday move upward of 7.52% on massive trading volume of over 23 million shares. This late-week surge caught a lot of traders by surprise, especially since the market was closed on Friday for the Juneteenth holiday, leaving investors to spend the weekend processing a massive new development. While the headline numbers show a stock that has experienced a blistering 174% run over the past 90 days, the real insight that most retail investors are missing is the simultaneous announcement of a brand new $500 million at-the-market stock offering. Normally, when a small-cap chip company announces that level of potential equity dilution, the stock tanks as investors panic about their shares being watered down. But instead, institutional buyers stepped in and drove the price up. This immediate contradiction shows that large institutions are treating this capital raise not as a warning sign of distress, but as an aggressive war chest allocation designed to secure manufacturing capacity for the next generation of high-power hardware supply chains. The common ground among retail investors using a standard individual brokerage or checking their balances on a Fidelity mobile app is that small semiconductor firms are too risky to hold when macroeconomic crosscurrents are swirling. The prevailing narrative suggests that unless you are hiding out in mega-cap tech giants like NVTS stock or Apple stock, you are exposed to extreme cyclical downturns and supply chain gluts. People see a company that reported a net loss in its recent first-quarter earnings report and immediately write it off as a speculative gamble. They assume that because the mobile phone and laptop charging market soft-landed, smaller chip designers will struggle to find a footing. This is where expectation clashing with reality becomes fascinating, because the underlying reality is that this business has systematically walked away from low-margin mobile chargers to position itself squarely inside the infrastructure upgrading cycle that is currently happening across data centers worldwide. When you look at online investing communities across various investing sites, the general sentiment around self-investing is often driven by momentum, but a deeper look into institutional order flow via the Interactive Brokers platform reveals a structural shift. Over the last month, trading volumes for Navitas have spiked significantly above their historical averages, driven heavily by block trades rather than just retail orders on the Robinhood app. This indicates that professional wealth managers and those handling large portfolios are accumulating positions. The reason is tied directly to the physical limitations of traditional silicon. For decades, traditional silicon chips handled power conversion perfectly well, but the sheer wattage demanded by advanced processing clusters has pushed legacy infrastructure to its breaking point. This is where gallium nitride and silicon carbide come into play, offering significantly higher efficiency and much better thermal management at high voltages. Investors who simply rely on automated algorithms or basic tools like a SoFi robo-advisor often miss these deep hardware inflection points because they only look at backward-looking price-to-earnings ratios rather than forward-looking design wins. Let us look closely at the recent price action and the daily swings to understand the forces at play here. Just a few weeks ago, the stock was trading under $10, and it has since rocketed to its current level near $24. This velocity of price appreciation usually triggers short seller interest, and indeed, short interest had been creeping up. However, the recent collaboration announcement with the NVIDIA MGX ecosystem to accelerate 800-volt direct current infrastructure completely flipped the script, triggering a massive short squeeze. When a company with a market capitalization of around $5.9 billion secures a direct seat at the table with the dominant force in artificial intelligence silicon, the addressable market assumptions change overnight. This momentum carried through the earnings reaction back in May, where despite reporting a wider net loss per share of 15 cents against the consensus estimate of a 5-cent loss, revenues actually beat expectations by coming in at $8.6 million. That revenue beat represented an 18% sequential growth from the previous quarter, proving that top-line traction is accelerating even as the company spends heavily on research and development. Please share your perspective in the discussion below by typing out a response to a specific question. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio, or if you prefer to stick strictly to larger sector leaders. To evaluate this business model properly, we have to look at what they actually do and how they make their margins. Navitas' design wins are centered around their proprietary platforms, which integrate power, analog, and logic circuits into a single chip. By replacing bulky silicon components with compact gallium nitride modules, they allow hardware manufacturers to create power supplies that are a fraction of the traditional size, while delivering double the power density. This design philosophy won them massive market share in consumer electronics originally, powering fast chargers for major smartphone brands. But as those consumer markets matured and margins began to compress, management executed a deliberate strategy to phase out lower-margin mobile contracts. That transition explains why their year-over-year revenue numbers looked lower compared to early 2025, a point that created an artificial bear case for analysts who were not paying attention to the changing revenue mix. The reality is that high-power market revenue grew 25% year-over-year in the first quarter, and that high-power segment now commands much higher gross margins, which expanded to 39%. This brings us to the macroeconomic pressures and the wider sector momentum affecting online investing strategies today. High interest rates have made it incredibly expensive for hardware companies to build out physical infrastructure, which has forced enterprise data centers to optimize every square inch of their facilities. If a data center operator can upgrade their power delivery systems to handle higher voltage without needing to expand the physical footprint of the building, the cost savings are immense. This reality has insulated the high-power semiconductor niche from the broader capital expenditure slowdown that has plagued other parts of the technology sector. Investors managing their own capital through Fidelity Investments or SoFi Active Investing are starting to realize that the power bottleneck is the single largest threat to advanced computing clusters. It doesn't matter how fast a graphics processor can compute if the local power grid and the internal power delivery boards cannot feed it stable electricity without melting the components. When you look at older reports and past performance, the company was heavily criticized for its cash burn rate and its reliance on capital markets to fund operations. Critics pointed out that launching complex semiconductor products requires hundreds of millions of dollars in upfront fabrication costs before a single dollar of commercial revenue is realized. That historical skepticism is why the stock spent a significant amount of time languishing in the single digits throughout late 2025. But the balance sheet reality today is vastly different. Ending the first quarter with $221 million in cash and absolutely zero outstanding debt gave them a highly stable foundation. When you add the newly announced $500 million at-the-market offering, the company is effectively ensuring that they won't face a liquidity crunch as they scale up manufacturing for their new isolated through-hole packages designed for silicon carbide modules. This structural safety net is something that traditional fundamental valuation models, like those used to generate price targets on mainstream investing sites, often struggle to quantify accurately. Looking forward, there are several distinct scenarios and catalysts that will determine whether reality can continue to outpace market expectations. The most optimistic scenario relies on the rapid adoption of their 800-volt power delivery boards, which are currently undergoing intense system-level validation by multiple global enterprise customers. If these validation cycles convert into long-term supply agreements by the end of this year, the current revenue forecasts of $41.3 million for the full year could prove to be far too conservative. This would validate the premium multiple that the stock is currently commanding and force mainstream analysts to aggressively revise their price targets upward. For anyone tracking their individual brokerage account or using advanced platforms like Interactive Brokers Trading to map out options chains, these upcoming product qualification dates are the critical milestones to watch. However, we must also weigh the significant risks and the downside scenarios that could break this upward trajectory. The single largest risk is the execution dependency on customer adoption timelines. Semiconductor validation is a notoriously slow and meticulous process. A single engineering flaw discovered during component-level testing can push back commercial deployment by 6 to 12 months. Because the market has already priced in an exceptionally smooth ramp-up, any announcement of a validation delay or a design rejection by a major data center client would cause a severe re-rating of the stock. Furthermore, the company faces intense competition from established giants who have deeply entrenched relationships with global hardware manufacturers and significantly larger balance sheets to subsidize their own next-generation power chip development. If a larger competitor lowers prices aggressively to protect their market share, Navitas could see its gross margin expansion stall out completely. Another layer of reality that investors need to monitor is the broader macroeconomic environment and its effect on online investment capital flows. If inflation re-accelerates or as central banks keep monetary policy tight for longer than anticipated, speculative capital will flee small-cap growth stocks and return to the safety of short-term government bonds or mega-cap tech holdings like Tesla stock. When market liquidity dries up, stocks trading at high multiples relative to their current revenues tend to suffer the sharpest corrections, regardless of their underlying technology. This is why investors who handle self-investing need to understand the structural difference between a company's operational success and its stock price volatility. Navitas could execute its production roadmap perfectly, but if the broader market experiences a systemic liquidity shock, the share price will still catch the downdraft. To wrap everything up and look at the big picture, the central tension governing Navitas Semiconductor is the massive gap between what the average trader expects and what the operational data shows. The expectation, visible in standard retail trading forums and simple automated screeners, was that this was a struggling, unprofitable chipmaker losing revenue due to a cooling smartphone market. The reality is that the management team successfully completed a massive pivot toward high-power enterprise infrastructure, aligned themselves with major ecosystem partners, and aggressively capitalized their balance sheet to fund the manufacturing scale-up. The recent closing price of $24.02 reflects a market that is rapidly waking up to this transition, turning a former short squeeze candidate into a serious institutional accumulation story. Whether you are placing trades through a Fidelity brokerage account, managing a long-term position via Schwab Intelligent portfolios, or actively trading volatile swings in Robinhood investments, understanding this structural realignment is the key to navigating the stock. The long-term upside depends entirely on their ability to convert current system validations into compounding revenue before their cash runway shortens, making this one of the most compelling high-stakes hardware stories in the market today. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor.
Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Bags, $. Don't forget to like, comment, and share this video to support the channel.